So, mortgage demand is at a 22-year low, according to CNBC. What that means, I believe, because they don't exactly state it in the article what they're referring to by mortgage demand, I assume they mean mortgage applications. And I don't know if they're just saying that purchase applications are at a 22-year low, or if that also is including refis. But nevertheless, it is not a good indication, no matter what the details are, for mortgage applications of any mortgage demand of any kind to be at a 22-year low. What I have to say is not shocking, because we are experiencing the highest mortgage rates currently since 2008. And as we all know, 2008 was not a very good time for the housing market. It wasn't a good time for really any market. But I have to say, I'm usually not a fan of CNBC. But this article wasn't too bad, because they got to what the real point, what the real meat of this issue of declining mortgage applications or declining mortgage demand is all about, and that is the purchasing power of home buyers. Mortgage rates have pretty much doubled this year. At the end of last year, we were in the twos. Got down, 2.25, 2.5 on average, depending on who you look at. I'm looking at, and I'll link to this in the description, Freddie Mac's data that is published by the Federal Reserve. And so, you have the central bank and a government agency, so the statistics might not be totally honest. I have seen averages that are higher than the Freddie Mac average. But, and this is for a 30-year fixed mortgage rate. But because the data set does go back, a long ways, you can look at a lot of it. It is consistent, I believe. You can compare it against itself. And so compared against itself, mortgage rates have pretty much doubled. And so what that means is that the purchasing power of borrowers has pretty much been cut in half. Or actually, that's not totally right, because your interest payment would have doubled, but that you also have to factor in the principal into what your actual mortgage payment would be every month. And I can't do that math in my head while I'm walking around pacing, recording this audio. But nevertheless, when your interest payment doubles, you cannot afford as big of a principal. You're not going to be able to afford nearly as big of a principal. And so everyone across the board has had their purchasing power slashed radically. And so now, because housing prices haven't really come down anywhere yet, home buyers are looking at how big of a loan they can qualify for. Because remember, what the purchase price you can afford is based off of what the monthly payment is going to be for you. The lower the interest rate, the more principal you can afford to take on, because that interest rate is not going to make up as big of a chunk of your monthly payment. But as the interest rates go up, your income stays fixed, the maximum monthly payment that you can pay, total combined principal and interest, doesn't change. And so if the interest payment is growing, your principal payment that you can afford is going to shrink. And if the principal shrinks, you're not going to be able to buy as big of a house. Or in the case of many Americans, you're not going to be able to buy any house. And so obviously that's why mortgage applications are dropping, because people are looking at the housing market. They're looking at how much they can qualify for, and they're saying, I can't buy a house for that. Where I am, a 2-bedroom house under 1,000 square feet, no garage or nothing. You're lucky if you have a carport. $350,000, and that's not in a particularly nice neighborhood. It's not in the hood, but it's okay. It's a house that you can live in. It's a roof over your head. That's all it is. It's nothing nice. It's nothing fancy. Obviously nothing big. It's under 1,000 square feet, but that's what you can afford if your purchase price is $350,000. And if you just barely could afford that before, and now mortgage rates have gone up, if you could just barely qualify to purchase a $350,000 house, back in like November of last year, and you waited till now, or you hadn't been able to find a house, and now mortgage rates have doubled, now you probably can only afford, like a $250,000 or $225,000. I'm just taking wild numbers out of my head, but you get the point. You can afford a lot less house now than you could before. And so all these people are dropping out of the housing market. And obviously people are not going to be refinancing if mortgage rates are going up, because the rate that they would refinance at is probably higher than whatever mortgage rate they got when they bought their house. And so this is also why we're seeing existing home sales fall off a cliff. I forgot, I should have left the tab open. I can't remember now exactly how much existing home sales have declined, but that came out earlier today too. Yeah, you can Google it. It's in the news today. Google existing home sales data today. But anyway, that's down to, as you would expect, because people cannot afford to buy the houses on the market. There's very few people who have the resources to buy these homes. And the people who were, in the mid to the upper tiers of the housing market before, back last year in November, they're now getting pushed down into the lower tiers. And a lot of them might say, you know what, I'm not going to settle for a crappy little house when, I have, more exorbitant tastes. Because oftentimes wealthier people, they don't often have to move. A lot of them move because they want to. And so if they have the option of staying where they are rather than moving, they might just do that and try and wait out this housing crash. But I don't want to overstate the significance of that, because most people move because they have to, because they're changing jobs, because they lost their lease, or something like that, having to move in with, to be with family because of some medical issue. Usually people aren't just moving for the heck of it. But for those who were looking last year and didn't have to leave where they were, and again, that might be why they waited, because they were not in a rush to buy last year, because they were saying, you know what, I'm okay where I am, I'm going to wait until I find a house that I really like. Well, now, all of a sudden, their purchasing power has been slashed, and they look at the houses that they now can afford, and they say, you know what, no, I'm not going to move at all now. I'm just going to sit right where I am. And a lot more people now, and even just anecdotally, but you're also seeing this show up in the numbers, in the rise in housing inventory. People know what time it is. They're waking up, and they smell the ashes. And so they're trying to get out of this burning building before it collapses in on them. They're selling their homes, even though many of them have nowhere to go. I was talking to someone yesterday who, lived in a house that he didn't very much like, and he just sold it for nearly $1 million, just because he thought it was absurd that it was worth that much, because he didn't really like the house. He didn't think it was a very nice house, and so he got to just get out of there. And he figured, hey, even if he goes and buys another house and he has to take the depreciation on that. If he buys a smaller house, let's say he goes from a $1 million house down to a $400,000 house. Well, the depreciation on that $400,000 house in dollar terms is going to be a lot less than that $1 million house. So he's going to be able to pocket, the money, a lot of the money that he made from selling this house still, if he moves into a cheaper house. And again, it might not even be a house that he likes very much, but it's just a way of trying to, insulate yourself from this market, because people realize this is going to be volatile. This is going to be rough. I know someone else who, might have waited too long, who's trying to sell their house, and, they had a deal before, and the deal fell through because, a house didn't appraise, and this person couldn't afford to make up the difference in the mortgage, the buyer that they found. And, now they're going to have to put it back on the market and hope that they find somebody else who's willing to, pay an exorbitant price for their house, or maybe they'll have to settle for less money. And, that's the way that housing prices come down. It's when buyers stop paying ridiculous prices and, people have to start accepting less money, and then that pushes prices down. And so you're going to see more folks trying to take advantage of this housing bubble before it completely bursts as the air is coming out. And they're going to load up and start, throwing their houses on the market. Not to mention the people who are going to have to start selling their homes because they can't afford the payment anymore, because they went out and maxed out their credit cards, metaphorically speaking, when they bought their house. They went out and said to the mortgage broker, what's the biggest principal I can qualify for? And they said, you know what, here's what you can qualify for. You can qualify for a $600,000 house. And they went out and bought it. And they can just barely scrimp by making those minimum payments every month. Well, if they lose their job, or if their work slows up and their income takes a little bit of a dive, they're not going to be able to afford that payment. And they're going to have to put their house on the market too. And that's when you really get a crash, when people are forced to sell, when people not only want to sell, just because to take advantage of high prices, but when people are forced to, when they don't have a choice because they can't afford their mortgage anymore, because they're losing their jobs, because we are in a recession. It's funny looking back at mortgage rates back in 2018, which I don't talk about as much as I used to, but boy, did it's really just festered with me how the Fed kicked the can down the road. We could have gotten this all over with back then, and it wouldn't have been as bad, because the bubble wasn't nearly as big back in 2018. Mortgage rates got up to like 4.85% back in 2018, near 5%, and that before they crashed down, into the twos. I mean, it's just so clear when you look back at Q4 2018. We were ready for the recession. We could have gotten it over with. We could have been well 4 years into the recovery at this point. But instead, we're just starting the recession. And so it's going to be so much worse now than, had Powell just ripped the Band-Aid off 4 years ago. We wouldn't have had all this inflation. We wouldn't have had as big of a bubble burst in stocks, bonds, and real estate. But since the bubble has blown so much bigger, I hope that it crashes just as far. I don't want this to be a simple 20% or 30-something% crash in housing, because that would only set us back a few years back, when housing was still in a bubble. In order for housing to be out of a bubble, it needs to fall 50% or more. It's tough because I have to factor into my head, inflation of the dollar. I can't just think of, okay, when were housing prices at their long-term average? I'm thinking, the houses that are now way overpriced, what were they priced at, back in like 2012, when we got back to the long-term average, when we reverted to the mean, okay? Now, all that was in 2012, that was mean reversion. The mean is not supposed to be the low. The mean is supposed to be the middle. So sometimes housing prices would be below the mean, sometimes they're above the mean, but eventually they always revert to the mean. In the last two housing bubbles, the one that ended back in that peaked in 06, and then the one now that is peaked in 2022, 2021. In both of these housing bubbles, U.S. real estate prices have remained above the mean for years and years and years. And so now for housing prices to revert to the mean, I mean, it would be a much more catastrophic crash. And I hope it happens, because people deserve to be able to own a home. I know very few people who make enough in my area to actually live here. And that's not a good thing for it. It's not like this is New York City. And even in New York City, that's a bad thing, when people can't afford to live where they work. I don't think that's a healthy thing, that everyone has to commute an hour. If you're living on $50,000, per year, you're not going to be able to pay $3,000 a month in rent for, a basic house. That's rent for what historically would be considered a starter home, a 1,500 or so square foot 3-bedroom 2-bath house. Three grand. That's about what rent is, where I am. So if you got a kid or two, you have to be making 6 figures. Actually, you have to be making well over 100,000, because 3 grand times 12 plus tax. Even without tax, that's 36,000. And what is it that all the rule of thumb is? Your rent or your mortgage, actually I think they even include insurance and all that stuff. Your total housing expenses is not supposed to exceed 28% of your income. And so maybe a married couple, both working full-time jobs, and earning at least 70,000 or so a year, and assuming that they both get to keep their job, because if one of them loses their job, they're screwed. Maybe they would be able to live in a house, not a nice house, just a basic house, with maybe 1 kid. 2 would probably be pushing it. They'd probably be, eating out of a Kraft macaroni and cheese for dinner every night. Or like Marukan ramen, not even Shin ramen. Okay, this is not normal. This has to end. This is not conducive to a healthy society. And I wish I could communicate this message to the Fed. Not that I think that they're reasonable people or anything like that. Not that I think that they care. They clearly don't. But I do think that a lot of their inaction comes from them being out of touch. I do think that Jerome Powell, in his heart of hearts, thinks that he's a good guy. And so there may be some reasoning in there that you could appeal to. I do think that there might be some change in the way that the Fed acts if they had any perspective on just how much they've effed up American society. There's a great book by Jorg Guido Holzmann called The Ethics of Money Production, just talking about how when you manipulate the money supply through the banking system and such, creating dollars here and destroying dollars here and there arbitrarily, how that distorts the incentive structure of society and markets, and rewards and punishes people arbitrarily and unfairly, and how that just is going to mess with people. I have pointed out before, I've cited the ads that I've found for new homes in the 1950s that, based on the purchase price they were being advertised at, they were like $1,300 or something for a house. You could afford, even with the mortgage rates of the 1950s, which were about where they are now, they were in the 5s in the mid-50s, on a minimum wage salary, you could afford to buy a brand new house and own it yourself free and clear. On minimum wage, you could buy a brand new house in the 1950s with interest rates in the 5s. And no, that's not a reason why we should raise the minimum wage. All that is a sign of how screwed up everything is. So, with that said, I will see you folks back here tomorrow.